What's the mood around here?
The mood here is unbelievably positive. We've all been to conferences where there's a distinct tone. I was on a panel this morning and people said, is this the best of times or the worst of times? And I'd say generally people feel really good.
And why is that? Like, what is it underlying economics? Is it deal flow? What's happening?
It's all of that. Number one, U.S. economy is on unbelievably strong fundamental footing. So I think people's portfolios are performing well. Returns are coming in the way that they'd want to. Liquidity in the asset class is good. One thing we talked about this morning that I also think is interesting, the growth generally in the private markets is now outpacing the growth in the public markets for the first time in 20 years. So I think there's also a distinct shift that despite whatever uncertainties exist, that the secular trend into the private markets is something that's going to sustain. So,
and what do you think catalyzed that sort of growth, that inflection point?
The shift?
Yeah.
It was noticeable post-crisis, and in all the conversations I have with our investors, both retail and institutional, my sense is coming out of the financial crisis, most people realized that they had completely misvalued liquidity, i.e. they had factored in the fact that they'd be able to go into the market, get liquidity at a price they wanted, and when they realized, when they went into the market, there was liquidity, but not at the price they expected, and it actually hurt return. So we've seen a meaningful shift into illiquid assets and a willingness on the part of most investors to actually take illiquidity risks so long as you're getting paid for it.
All right, so you guys were early to that market at Ares, especially the private credit market. How competitive is it getting with other people around these halls sort of nipping at your heels?
It's funny, I was here 6 years ago when they first did their private credit summit. I delivered the keynote address in a 10 by 10 room. I thought it was the green room where I was speaker prepping, and it turned out to be the main event. And now, 6 years later, you have the full day, full ballroom, and it's really emerged as an asset class unto itself. Like any asset class, as it develops and evolves, more people are in it, competition increases, but that's the natural evolution. I'm not experiencing that competition as compromising the return opportunity in those asset classes. I think a lot of the people who are allocating tend to be smaller first-time funds with a little bit more of a focused strategy than what we pursue at Ares.
And still the appetite, a hearty appetite on the part of institutional investors for this specific type of asset?
Without a doubt. In addition to the illiquidity appetite coming out of the financial crisis, the other thing that there's an insatiable appetite for globally is yield. And when you look at private credit, whether you're talking about corporate lending or real estate lending or structured and asset-backed credit, the opportunity to generate current yield, senior secured, floating rate is very, very attractive to investors, and I don't expect that to change.
How much do you worry about interest rates rising?
I worry if they're rising for the wrong reasons. Obviously, when rates are going up because the economy is fundamentally sound, that's constructive for credit. It means that earnings are moving in the right direction. About 80% of the credit assets that we manage at Ares are floating rate. So again, generally when interest rates go up, our returns go up. The mitigant and offset to that is obviously if rates go up too fast or too much, it constrains cash flow and ultimately could lead to stress. So it's something we keep an eye on, but I'd say on balance, it's actually a positive for our business.
Biggest worry for 2019 going forward?
Oh boy, I just feel there's so much geopolitical uncertainty and movement, and when you saw what happened in Q4 of 2018, that technical shock that worked its way through the market, albeit short-lived, I think was a great reminder that the market, just based on their structure and tone, are still a little fragile under the surface. So from my standpoint, I can't point to anything specifically, but there's still enough risk of an exogenous shock that as a credit manager we have to be thinking about.
Just briefly, because you mentioned the end of 2018, that was a big shock, the Christmas Eve shock, but it seems so long ago now. Are we due for another one?
I don't know. I kind of hope so. It was a little bit of an appetizer. Those are the types of markets where Ares actually performs the best. You know, when the retail investor is moving out of the market, when the daily liquidity is having assets traded value below their intrinsic value, that's when Ares can come in and really be a liquidity provider into those markets. So it was an enjoyable couple of months, and it's now since recovered.
This market could use a little more volatility.
I wouldn't mind.